Hello everyone, welcome to another class of Lesson Up Squad Manufacturing Part 4. So today we are going to be looking at production cost statement, income statement, as well as the notes that go along with it. But today I decided to do it in the form of example rather than just a format. So if you haven't watched any of my previous videos, please go to look at it, part 1, part 2 and part 3 of manufacturing, because we are going to be I'm not going to be discussing any of the concepts, right? We are rather going to be doing calculations on these concepts. So it's very important that you first understand those concepts before we can do these calculations. So let's have a look at our required of the production cost example statement. So we need to use the information on Noel manufacturers to prepare the following for the year ended 30th August 2014. A production cost statement, income statement, and all the relevant notes in order to show the working out. So this is the information that is given to us. We have an extract from the balance sheet on 1st September 2013. These are all our opening balances of raw materials, work in progress account, finished goods, consumable stores, the cost of factory equipment, and the accumulated depreciation on the factory equipment. Then we have our closing balances on 30th August 2014. All the closing balances have been calculated except work in progress, which we need to calculate. Then transactions for the year that happened from 1st September 2013 until the 30th August 2014 was we purchased direct raw materials, right? It was purchased on credit and cash. Then we had carriage on raw material. This was a transportation cost to get the raw materials to our warehouse. Then we have raw materials which were in our factory, and they were returned to the creditors because either those goods were obsolete, or they were defective, or they were not conditioned well by the suppliers, so now it's going back to the supplier. We also have salaries and wages. Now this includes 180,000, and of this was for direct labor. So wages were paid most probably to the direct labor. Then 80,000 rand was administration expenses. Remember, administration expenses are not our factory costs. They are like our office costs rather. And then the balance was indirect labor costs. So our total salaries and wages paid out was 360,000. So to get our indirect labor costs, we are going to take the 360,000 and subtract the 180,000 and 80,000 to get our indirect labor cost. So now let's look at all the additional transactions for the year. Now I have done all the calculations here, and as also I have indicated that where does the calculation belong to. I've highlighted that in yellow. So our first one says that depreciation on factory equipment must be written off at 12% per annum on diminishing balance method. Now because it's factory equipment, it belongs to factory overhead, because remember we said factory overhead is our indirect labor, indirect cost, and as well as all our other factory costs, and this depreciation belongs to the factory, so it goes under factory overhead. So whenever we're calculating our whenever we're calculating depreciation using diminishing balance method, we always take our cost or carrying amount minus accumulated depreciation times the diminishing balance rate. We know our cost of the equipment is 1 million. It was given to us, and then we deducted with the accumulated depreciation of 240,000, and then multiplied it with the diminishing rate of 12%, which gave us 91,200. Our second one says that depreciation on office equipment amounts to 2,500. So because the office equipment, you account it as administration cost, and we did not need to calculate our depreciation on office equipment. They already gave it to us. Then it says 11,000 rand for sales vehicle. This is the cost incurred for selling the vehicle was 11,000 rand, and that's why it goes into our selling and distribution cost. Our third one says that rent amounting to 500,000 was paid during the year. The factory uses 60% of the floor space, the office uses 15%, and the sales department uses the rest. So now I have taken the 500,000 and I have divided it amongst our factory, office, and sales department. So we know our factory uses 60%, our office uses 15%, and the sales department uses the remaining, which is 25%. So when we calculate the 60% of 500,000, it's 300,000. 15% of 500,000 is 750,000, and 25% of 500,000 is 125,000. So now the rent in the factory goes under factory overhead. The rent in the office goes as is accounted as admin cost, and the rent in the sales department is accounted as selling and distribution cost. Next, it says that other expenses were electricity, which was a total of 344,000. Factory used 320,000, office used 10,000, and the sales department the rest. So again, I've taken the electricity and I have divided it amongst factory, office, and sales department. And then the remaining of sales department was 14,000. So again, the electricity in our factory goes under factory overhead. The electricity used in the office is accounted as admin cost, and the electricity used in the sales department is recorded as selling and distribution cost. Then it says that sales vehicle running cost was 72,000 rand. This is our selling and distribution cost. Next, we have sundry expenses is 90,000 rand. These are split in the ratio of 4:1 between factory, office, and sales department respectively. So we know that the total sundry expenses is 90,000 rand, but now this 90,000 rand has 6 parts of expenses. It has 6 parts, right? And how do I know it's 6 parts? Because I added the ratio 4 plus 1 plus 1, which is 6. So we have I have again taken our ratio and I've just put it under each department or under each cost. So you can see for factory we use 4 parts of 90,000, for office we used 1 part of 90,000, and sales department we use 1 part of 90,000. Now to get my cost, what I do is I say the value times what I want over what I have. So you know that for factory we have 4 parts are used from the 90,000 rand for the factory. So I said 90,000 times 4 because that's the value we want. We want the 4 parts that are used in the factory, right? Divided by 6 because that's what we have. We have the total 6 parts of 90,000 rand. Right, then again the same thing goes with office and sales department. We calculated the value times what we want over what we have. So for office we got 15,000, and sales department we have also have 15,000. Now it says sales amounted to 3,600,000. Sales goes under our income statement. Then it says commission paid to salesperson is 5%. So we assume that the salesperson is paid 5% on the sales amount. So we say 3,600,000 times 5%, which gives us 180,000. And we record that as our sales and distribution cost. Why? Because this is the cost incurred while we sold our product. So the salesperson sold our product, and that's why we gave them a commission of 5%. So we record it as sales and distribution costs. And lastly, they tell us that markup is 50% on cost. Because it's 50% on cost, it makes cost our base price, and thus cost is equal to 100%. So we get a markup of 50%, right? And then our selling price equals to 150%. That's we get 150% by adding the 100% plus the 50%. Now we need to calculate our cost price because we need to use the cost price in our income statement. They've already given us our selling price. Now we need the cost price. So whenever we're calculating cost price or selling price, we always use the formula, the value times what we want over what we have. So we have our value, which is 600,000. This is our selling price. Then what do we want? We want our cost. So we multiply it with 100, and we divided it sorry, we divided it by what we have. What do we have? We have selling price. That's the value we have. We have a value of selling price. So we divided it by 150%. And this gives us 2,400,000 of cost price. And now we can use that in the income statement. So far we have read the required, which said that we need to draw up a production cost statement, income statement, and also we have to do our notes. We also did some of the calculations for our transactions for the year. Now, this is our production cost statement format, which will never change. So now we're going to look at each of the line item, and we're going to deal with them individually. And you can see I have notes for direct material cost, direct labor cost, and factory overhead. So firstly, let's look at note 1, where we calculate our direct material costs used in the manufacturing process. So if you go to your information sheet, right, you see we have an extract from balance sheet on 1st September 2013, and the opening balance for raw material stock is 180,000 rand. So this was our balance at the beginning of the year, which was given to us, and we have recorded it. Then in the year we have purchased more raw materials, and you can see that under transactions for the year they've done credit purchases of 600,000 and cash purchases of 460,000, which we have also added up here. And then the raw materials that is returned to the supplier, because now we no more have those uh, direct materials, right? So we returned it back to them. Now we don't have them, so we deducted the minus 24,000 then. Then carriage on purchases is also given to us. This is our transportation cost of direct materials from direct materials to the warehouse, right? And we get a total of 1,366,000 after adding all the above up. Now we want to know that how much was used in the current year, right? So that's why we go and deduct the leftovers at the end of the year that we have on hand, right? So they had, at the end of the year, they had on hand 64,000. This was also provided. Um, so we deducted it, and now we get a cost of 1,302,000. So this is the cost that incurred with direct material in the manufacturing process for the current year. Note 2 is about calculating direct labor cost. So we firstly have our factory wages. This was provided to us. If you go under the information where they tell us about the transactions for the year, under salaries and wages paid, they tell us that 180,000 rand of this was for direct labor. So we just put that down. Then UIF contribution and skills development levy, we didn't have any of these costs, but you can have them. And if you do have them, remember, you only account for the one that is paid by the employer. By the employer. Then you calculate your direct labor cost, which amounted to 180,000 rand, and you use the 180,000 rand to put it onto your production cost statement. Now 3 is about calculating factory overhead costs. We have our consumable stores, where our opening balance was 14,000. Then we did more purchases of the consumables, which was 44,000, and then we deducted it with the closing balance, 6,000. All of this information was given to us. Then indirect labor, we have salaries and wages. So if you go back to transactions for the year, and if you see under salaries and wages paid, it said 180,000 was for direct labor, 80,000 was administration expense, the balance was for indirect labor cost. So remember in our previous calculation, we just took the 360,000 minus 180,000 and then minus the 80,000. So we got our remaining indirect labor costs. Then we also calculated our depreciation. We have already discussed this, the depreciation on factory equipment. We also calculated the factory portion of rent, electricity, and sundry expenses. We already did those calculations, and now I just recorded them here. Remember I told you that under factory overhead costs, we have our indirect labor, indirect material, and any other factory costs. But remember, it must only be for the portion of factory, not office, not admin, not sales department, just the factory. And we got a total of 923,200. Coming back to our production cost statement, we have calculated direct material, direct labor, and factory overhead in the respective notes. So now we add up direct material and direct labor, which gives us our total prime cost. And when we add factory overhead to prime cost, it gives us our total manufacturing cost. But we also need to calculate our cost of production of finished goods during the year. And how do we calculate that is by taking the total manufacturing cost, adding it with work in progress at the beginning of the year, and this gave us 2,485,200. Right, so they gave us the work in progress at the beginning of the year, but we do not have our work in progress at the end of the year. We still need to calculate it. But this is a bit tricky to calculate. Why? Because we don't have any information on it, and also we don't have our cost of production of finished goods, so we can't calculate the balancing figure of work in progress. So we do have some of the information for cost of production of we do have some information to calculate cost of production of finished goods. So once we get that value, we can then finally calculate the balancing figure of work in progress at the end of the year. So let's now go to calculating our cost of production of finished goods during the year. So there are two ways to calculate cost of sales. One way is value times what you want over what you have, which we calculated previously. And remember, we got our 2,400,000 cost of sales. And the other way is this way, where we take our opening stock of finished goods plus the cost of finished goods produced during the year minus closing stock of finished goods. So we have already calculated our cost of sales. But the reason why I'm using this table, the other way to calculate cost of sale, is because we can calculate our cost of finished goods produced during the year, which we can then use in our production statement. So we already have our opening stock of finished goods of 70,000. Cost of finished goods produced during the year, it's still missing. We have no information on that. Then, but there is a way to calculate it. Then closing stock of finished goods, we had that value also minus 80,000, which gives us our cost of finished goods sold, meaning our cost of sales, 2,400,000. This has also been calculated, right? We calculated it by using the formula value times what you want over what you have. So when we have all of these three figures, we can calculate our finished goods produced during the year by taking 2,400,000 plus 80,000 minus 70,000. We reverse the calculation and then we get our total value 2,410,000, which gives us our cost of finished goods produced during the year, and this is the value we can use in our production statement. So now we're coming back to our production cost statement, where we calculated our primary cost, our total manufacturing cost, and then we added the work in progress at the beginning of the year and got a total of 2,485,200. Now, previously our work in progress at the beginning of the year and cost of finished goods were not there, the value were missing. Now we have our value of cost of production of finished goods, 2,410,000, because we calculated our cost of sales. We calculated this by using our cost of sales formula. So when we got this, now we can calculate our work in progress at the end of the year by looking for the balancing figure. So that's how you get your 75,200. Now we can drop our income statement as per the required. So we have our sales. Sales was given to us 3,600,000. Cost of sales, we calculated it previously, 2,400,000. Then we take our sales minus cost of sales, which gives us gross profit, and we get a value of 1,200,000. Now, in order to calculate our net profit, we also need to deduct other expenses, and the only expenses we had in this scenario was selling and distribution costs and administration costs. So we can discuss on these calculations separately. So let's just look below. In our note 4, we calculate selling and distribution cost. Now we have discussed all of these costs when we were doing our transactions calculations, and we have spoken about all these transactions. So I'm just going to do a quick overview of this. Depreciation sales vehicle was given to us. We didn't need to calculate the depreciation. Rent, we only took the portion of sales department. Electricity, we also calculated the portion of sales department. Sales vehicle running expenses was given to us. Sundry expenses, we calculated the portion for sales department, and commission, we even did that calculation. So you can go look back at it. And then our selling and distribution cost was 417,000. So we have our administration cost calculated under note 5. So salaries was given to us, and then we calculated depreciation, rent expense, electricity, and sundry expenses only on the admin part, and we've added it under administration cost. All these calculations have already been done, right, when we're discussing our transactions. And that gives us our total of administration expense of 182,500. And now we record this in our income statement. We record the administration cost and the selling and distribution cost from the notes. We record it from the notes to the we transfer it from the notes to our income statement. So now we are finally done with the whole of manufacturing syllabus, and we have come to an end of it. I really hope you guys enjoyed the lesson, and I hope this lesson gave you some valuable knowledge. Until then, please feel free to contact us on Instagram or WhatsApp, or drop us a mail at Lesson Up Squad, and also please subscribe to our YouTube channel Lesson Up Squad. Till then, I'll see you next time. Goodbye.